Welcome guys to another video of Purposes Trade, and on this video I want to talk about a topic I've been trying to talk about for a while, which is basically how does the Forex market work? What does the future look like for the Forex market? And if how you can make money in the Forex market if you're trading on your own or if you're a Forex trader working for a big bank. Let's get right to it. Let's not waste any more time. So, one sec. First, let's talk about what's the Forex market. It's short for foreign exchange market, for those of you who don't know. So basically, it's a market where you can swap one currency for another currency. So if for any of you who have traded in the Forex market, you probably know this. So you'll go to the Forex exchange, you'll see financial instrument, for example, it's labeled USD slash CAD. So it's US dollar slash Canadian dollar. And what that means is for one US dollar, how many Canadian dollar I can get. So if it's currency A slash currency B, it basically means for one currency, one of unit of currency A, how much of currency B I can get. It's really that simple. Okay. And so that's what the financial instrument labeling looks like, what it means. And now let's talk about the fundamentals. So first thing first, let me give you my hypothesis of what exactly goes on in the forex market, especially right now. And the simplest way to think about the forex market is rich countries gives loan to poor countries. So rich currencies are converted to poor currencies to give out loans to poor countries. That's the simplest idea of the forex market. And I'll explain what I mean. So if let's say let's talk about the rich countries first. What's the biggest problem with the rich countries? Whether it's the G7, compare the G7 Western countries to the rest of the world. What's the biggest difference? What's the biggest problem of the G7 that the rest of the world, the middle income, the developing nations are not facing? Well, the Western G7 nations, the richest on paper, are basically, in many cases, on a decline and many cases stagnating. But all in all, they're not growing. Okay. And now you might say, oh, USA grew by 2% GDP this year, blah, blah, blah. Yeah, but get rid of inflation, right? USA grew by 2% GDP, and then from that, you have to subtract the inflation. So, yeah, if you subtract the inflation, the actual rate of growth of USA is zero. And most of the other countries like Canada, European Union, a lot of countries, they have their GDP growth on paper of around 0.1%. And from there, if you subtract the inflation, they have negative growth. They're basically declining. So the biggest problem of the rich currencies, the Western G7 nations, is that they're not growing, they're stagnating, and you don't want to give money to someone who's on the stagnation and decline. It's pretty simple, right? If I had $100 and this guy wants $100 from me, well, the first thing I'll ask, the major thing I'll focus on is can he pay me back that $100 with debt, with interest? So what will I look for to see his credibility for paying me back? Well, his growth, right? Um, if he's already his balance sheet is already negative, you know, and I'm still interested in giving him money, the only thing I'll care about is growth. If he's growing his income, so he can use that new earned income to pay me back. So I've talked about this in a previous video. Most Western countries since COVID, their GDP, so their government's net assets, net equity has been negative. What that basically means is that the Western G7 countries, and you can see this, there's public data on this, the governments of the Western G7 countries have less assets on their financial balance sheet than they have liabilities. So they have net equity. And this started in COVID and it dipped below zero, the equity level. And so now it's negative equity. So basically, most Western G7 governments are broke. Okay. And they have all these welfare obligations coming up. We talked about that, the pension, the baby boomers, and all that. That's a different story. So the governments are broke. The economy is not growing. Why will I give money? Okay. First of all, they can't even probably pay back their current liabilities. And on top of that, if they're not growing, the likelihood of them returning my money in the future that I give them is zero. It's close to zero if you think about it. And so that's why if your economy is not growing, you're likely a rich, matured economy with a negative balance sheet in terms of equity in the Western world. And likely your country is borrowing, is giving out loans to developing countries where the balance sheet might be negative. Look, China's negative. China's government's equity is positive. The Chinese CCP party, the Communist Party of China, owns all the public land. Okay, you can lease the land in China from the government. You can't own it permanently. And yeah, so they're smart, okay? And so the Chinese government still has significantly positive equity on the balance sheet. And yeah, if you're a developing country, the global south in Asia, you might have negative equity on a balance sheet if you're a small country, not like China. But if you're growing at 7%, 8%, people will still be willing to give you money because there's a very good likelihood you'll clean up your balance sheet and pay me back my loan. It's really that simple. That's where the big transactions happen in the Forex markets. I mean, yeah, sure, if you're trying to pay for your kids' university tuition fee in the Western world, or you're trying to send back remittance to your parents back home in the Eastern world, those are also major transactions, major volumes of Forex exchange transactions. But the biggest transaction in the Forex market is the conversion of a rich country currency to a poor country currency to hand out loan to the poor country and make some money. That's it. That's the biggest volume of trades that happens in the Forex market. If you're trying to understand the movement of the Forex market, you have to measure. So every Forex financial instrument comes as a swap. It's called a swap. So you have for currency A, 1 unit of currency A slash how much of currency B I will get. Okay, that's a swap. And you can basically go long or short of that swap. And so you're basically comparing the economic health of country A versus the economic health of country B. And if the country is poor, if country A is stagnating or declining and country B is growing, you're likely to see significant volume of money being converted from country A currency into country B currency to give out loan to country B, which is growing. So likely you're going to see a significant sell-off in country A currency and a significant demand to buy country B currency because you can only buy the bonds of country B with the country B currency. It's really that simple. And this helps to basically, in a fundamental sense, at least it should help to improve the valuation of the growing middle income and developing nations' currencies. But the reason it hasn't happened since COVID is because I talked about this in a previous video. You have a currency is there to trade physical goods, but and it's not since COVID. It has been happening for a long time. Actually, it started during the Vietnam War in the 80s. And what basically happened was a currency is supposed to be used for trading, period. Okay? You buy a good, you give a currency, or if you want to give out someone money to manufacture a product or whatever, it's basically involved in trading activities. Okay? But what the British have done after the end of the British Empire and what the Americans have done with the dollar since the Vietnam War is basically create these artificial non-trade related transactions in their currencies by helping local elites of poor countries loot their wealth, convert it into USD, increase the demand of USD, increase the valuation of USD artificially without any trading activity, and then transfer that USD of the looted USD into offshore tax havens. And that's the reason why, in theory, even though large sums of money is going from rich countries, stagnating economies into poor country, developing, growing economies, in theory, that should help to strengthen the growing, developing countries' currency. But it's not because of this second layer of artificial, illegal criminal activities, looted money transfer into offshore tax havens happening in the rich country currency. Does that make sense? And yeah, that's basically what's happening. And so, what can you do about it? Well, then the question comes down to how do you, as a trader, make money? Well, the first thing, if you have been trading in the Forex market, you know pretty well that in order to make any decent amount of money in the market, you have to do large volumes of trade. You can't trade $100 in the Forex market and make any significant amount of money because Forex market, the daily change in prices in the Forex swap market is very low. Forex market is actually one of the least volatile market. I mean, now it's getting volatile the last few months because of the transition in the world moving away from the US denominated SWIFT system and all that, the cryptocurrency, the Ripple and all that coming in, and then breaks. So there's a lot of transition going on. So that's why the Forex market has been more volatile than usual in the last few months. But if you compare the Forex market to other markets, the Forex market is one of the least volatile markets. So the price fluctuations is very low every day. And so you can't make money, a significant amount of money by trading $100, $500, unless you use leverage. But the problem with leverage is, yes, you amplify your profits, but you also amplify your downsides. And I don't recommend, especially if you're a new trader, to use leverage. And leverage should only be used if you even want to consider using leverage. Ask yourself, how sure are you of your bet? Okay, and even if you're sure of your bet, get into the bet just before the event happens. So, for example, let's say you're 100% sure that everyone is forecasting. Let's say, for example, Bank of Canada is going to lower the interest rate in the next meeting. 1 minute before the release of the interest rate announcement, that's when you will trade. Because before that, if you put in a 500x leverage, even if your bet is right, you're going to lose money because of the fluctuations and you'll get priced out and you'll get a margin call. And so your position will be closed out. So even if your bet is right, get into the bet just a minute to 30 seconds before the event happens. And the surety, how sure are you that the bet will be right? Okay, that's when you should use leverage. If you're very confident that everyone is saying that the Bank of Canada will cut interest rate, but you somehow you're trying to go in the opposite direction. You're trying to fight against the wave. You believe that the Bank of Canada will increase interest rate because they're more concerned about, let's say, inflation, then they're concerned about the economy, whatever reason. You think they're going to increase the interest rate. But all the economists, all the traders out there are saying they're going to reduce the interest rate. That's if you're confident, if you really think that's going to happen, get into that position, but just a few seconds before the rate announcement happens. That's it. Don't get into it half an hour, 30 minutes, 5 minutes before. No, because you'll get margin call because of the volatility in the system. Before the release of any announcement, there's a lot of volatility in the system. And yeah, so if you're trying to make money in the Forex, just understand that as a sole trader, using leverage is highly, highly not recommended unless you have a prediction that goes against almost all the economists and traders' predictions out there, and you're extremely confident of your prediction. And even then, get in just before the announcement. Don't get in a long time early, 5 minutes, whatever. Get in, try to get in a few seconds before the announcement happens. Okay, that's the first thing of using leverage in Forex. It's highly not recommended, but if you're gonna use it the right way, like I explained. And yeah, so when you're trading in the Forex market, just understand this: you're basically betting uh, how weak one economy is compared to another one, and the strength of an economy will be determined by how much it's growing. Okay, and the economy that's growing faster than the other economy will basically have more demand in its currency than in the other currency. And so that's how you position your bet in the forex market. But like I said, for individual trader, it's very hard because you have to do large volume of trade. You need a large capital to begin with, unless, and you don't want to use leverage all the time. Trust me. And so, like now, I just want to talk about how do the traders, forex traders, and the banks make the money, and they do exactly what I just mentioned, which is that they're trying to bet on the health of an economy versus another economy. So let's say USD CAD, for example. Everyone knows USD USA is growing faster than Canada, right? So for USD CAD, the swap basically means that for one USD, how much Canadian dollar am I getting? So if I'm betting on the fact that the US economy is growing faster than Canadian economy, then I'm betting on the fact that Canadian dollars will flow into US bonds because comparing Canada to US, I have a better chance of receiving my money back with interest in USA than in Canada. And I'm likely to get a higher interest rate in USA than in Canada because the economy is growing faster in USA than in Canada. So inflation is likely to pick up higher in USA than in Canada. So interest rates have to stay higher in USA than in Canada. So it's really this chain of thought process that goes in, which basically boils down to USA is growing faster than Canada. US economy is stronger than Canada. Money will be flowing in, converted from Canadian dollar into US dollar to buy US bonds. So sell off in Canadian dollar, buying demand in US dollar. So if it's a USD CAD swap for one US dollar, I'm likely to get more Canadian dollar because the Canadian dollar is having downward pressure and the US dollar is having upward pressure. That's it. That's basically what the forex traders in the banks do. And that's basically, they don't have to use leverage. Try to understand that they don't have to get in few seconds before a major news announcement. They can get in early and because they're not using leverage, because they're trading large volumes of the bank's money. And so try to understand the difference between them and you. And so this is basically what they do. And it's a bit more complicated if you're trying to let's say, with I just compared to G7 economies, right? It's easier to do the currency swap because they're part of the Western financial infrastructure, so it's easy to do the currency swap there. But if you're trying to, let's say, sell US dollar and buy Indian rupee, that's a different game ball. Okay, the Western financial infrastructure. It's connected to the rest of the world. Don't get me wrong, but it's more complex when you're trying to quote unquote buy sell a rich country currency and then buy a poor country currency, as they say. And so yeah, basically what happens in the forex market is right now and what's going to happen in the near term. And look, people have a contradiction beyond my take on this, which is that they'll say, well, then how does USA government borrow so much money? Who's giving out money to US government if US economy is stagnating and not growing? Well, we'll go back to my initial hypothesis, which ties back to all this logic, which is that in the forex market, the biggest volume of trade is rich countries giving money to poor countries or growing, stagnating rich countries giving money to growing poor countries. Now, if you want to think about how USA has piled up this massive $35 trillion debt and counting, then the question comes down to then who's giving USA money? It's a stagnating rich country currency. Um, shouldn't it be giving money out to the growing poor country currency? And it is. People are converting US dollar to buy bonds in the growing developing market in Asia and Africa. Now the question is then who's giving money to US government to buy these bonds, all this debt that US government is racking up? And the answer is actually pretty simple. They're doing what they've been doing the last 2 decades since the US has stopped growing, especially since 2008 financial crisis. They're basically printing money to buy their own bond. Okay. And the biggest purchaser of US government bonds has been the Treasury. Okay. So you have the Federal Reserve printing the money. Okay. And so they're buying the bonds from the Treasury and they're giving the money to the federal treasury, who then gives it to the US government. And so it's this cycle of basically US government printing money and then buying its own loan. And they're pushing a lot of their vassal states in European Union, Canada, and Japan and South Korea also to forcing them to buy these bonds, coercing them, and also the institutional investors inside the USA, the commercial banks and all that, they're kind of forced to buy these government bonds, because hey, You want free money, you have to buy our bonds. And yeah, so there's a lot of that coercing that goes on, but basically, no one in their right mind will buy US government bond. And also, another thing that comes down to why is China buying, why is China giving out money to USA? Go back to what I just said. Rich, stagnating countries are giving money to growing poor countries. So if you want to think about why China is giving out so much money to USA, comparing China to USA, basically China is a rich, stagnating country when compared to USA. Does that make sense? Okay, yes. If you're comparing just China and USA and just get rid of everyone else, China compared to USA is a rich, stagnating country compared to a poor, growing USA. This is something people don't understand. People say, "Oh, what do you mean? You're saying USA is poorer than China?" Yeah, that's basically what I'm saying. Okay, in terms of PPP, which actually what matters, purchasing power parity, which is basically the purchasing power of your population, China has surpassed USA like 20 years ago. Okay, people focus, especially in Western world, they want to focus on GDP because it looks good on paper. But you're in GDP, the GDP is calculated in Western countries' currencies. So obviously, like I mentioned, they're artificially pumping their currency. So obviously, they're gonna have a decent value in GDP. But if you look at PPP, which does gets rid of these artificially inflated Western currencies into the calculation, they get rid of that. PPP, China has surpassed USA 20 years ago. So China is a richer country than USA. And compared to USA, China is stagnating. Okay. USA was stagnating and then now it's compared to China, USA is actually growing. This is what people fail to understand. Yes, China on paper, they're growing 5%, 6%, but there's a lot of devaluation that all. If you get rid of all the other countries and you have just China and USA right now, China is richer than USA. China is growing. The real rate of growth in China is less than in USA right now. The US actually stopped growing for a long time, and it just started growing the last few years with all this new capital infusion into the economy under Biden and all that. So right now, China is actually the one handing out this billions of dollars of money to USA because they are now a rich, stagnating economy, and compared to them, USA is a poor, growing economy. In the bigger picture, US is still a rich, stagnating economy, but just compared to China solely, it's a poor, uh, growing economy. And so you have China giving out billions of dollars. I think they own $1 trillion worth of US bonds right now. So that's basically what's going on right now. And I know this is a controversial statement, but if you want to understand the Forex market, just keep this hypothesis of mine in mind. Poor growing economies, receiving money from rich stagnating countries. That's it. That's basically the entire dynamics of trade in the Forex market. Okay. So yeah, that's it from me for this video. I'll come back with another one. Until then, peace.